You've been saving up, you think you're ready to buy a house, so you go online, click check if I qualify, and suddenly you're staring at a rejection. No explanation, just no. Here's the thing, the bank isn't looking for a perfect person, they're looking for a predictable one. And once you understand the 5 things they're actually checking, qualifying for a mortgage gets a whole lot less mysterious. I've spent 12 years in banking. I've been a teller, a banker, a branch manager, a mortgage loan originator, and a trainer. I've sat across from thousands of people in that chair. Today, I'm going to tell you exactly what we're looking at. Let's get into it. Lenders use something called the 5 C's of credit. Now, this sounds like something out of a textbook, but stick with me, because once you know these things, everything about the mortgage process makes sense. Number 1 is credit. Your credit score is a report card that shows how reliably you've paid back money in the past. Most conventional loans want to see at least a 620 score. FHA loans can go down to 580, sometimes 500 with the right down payment. But the higher your score, the better your interest rate. We'll do a whole video on this. Number 2 is capacity. Can you actually afford the monthly payment? Lenders measure this with your debt to income ratio, your DTI. That's the percentage of your gross monthly income that goes towards debt payments. Most lenders want this under 43 to 45%. In some instances, with a strong down payment and reserves, you might be able to stretch up to 50%. Number 3 is capital. This is your down payment and your savings. How much skin do you have in the game? The more money you put down, the less risky you are to the bank. Number 4 is collateral. This is the house itself. The bank wants to make sure the home is worth what you're paying for it. That's what the appraisal is for. Number 5 is conditions. The type of loan, the purpose. Is it a primary home, an investment property, a vacation home? And yes, the state of the economy matters too. Today, we're focusing on the 3 you have the most control over: credit, capacity, and capital. Let me give you the real credit score breakdown that nobody puts in one place. Below 580, most lenders won't touch it. Not impossible, but you'll need specialty programs and a very large down payment. 580 to 619. Now you're in FHA territory, but options are limited and your rate won't be great. 620 to 679. Now we're in conventional loan territory. You're in the game, but you're probably going to have a higher interest rate than someone with a higher score. 680 to 739. Now we're talking. You're going to get competitive rates. This is where most first-time buyers land if they've done some work. 740 and above, this is the golden zone. Lenders are going to compete for you. Your rate goes down and your options go up. Here's something important. Your mortgage lender will pull all 3 credit scores from each of the bureaus: Equifax, TransUnion, and Experian. And they're going to use your middle score. Not the highest, not the lowest, the middle credit score. So if your scores are 710, 680, and 650, they're going to go with the 680. And if you're buying with a partner or a spouse, they're going to use the lower of the 2 middle scores. So if your middle score is 740, but your partner's is 610, you'll be qualifying at a 610 credit score. That's why I always tell couples, work on both scores before you apply. Okay, next let's talk about DTI, or the debt to income ratio, because this one trips people up constantly. Here's the formula. Take all of your monthly minimum debt payments, car payments, student loans, credit card minimums, any other loans, and divide that by your gross monthly income. Gross monthly income means before taxes. That percentage is your DTI ratio. Let me give you a real example. Say you make $5,000 a month before taxes, you have a $400 car payment, $200 in student loans, and $100 in credit card minimums. That's $700 in monthly debt. 700 divided by 5,000 is 14%. That's a solid DTI. Now, add a proposed mortgage payment of $1,400 a month. Your total is now 2,100 divided by 5,000. That's 42%. Most lenders will approve up to a 43 to a 45% DTI, so you'd be right at the edge. This is why paying down debt before you apply for a mortgage can make a huge difference. Even getting one credit card balance down can shift your DTI by a few points. Here's a pro tip. If you're self-employed, this gets more complicated. Lenders typically use your net income after business deductions from your tax returns, not what you actually deposited. Your taxable income and your real income can look very different to a bank. That's a whole separate topic for its own video, though. Now, let's talk about income. The question isn't just, do you make enough money? It's, does your income look stable and predictable enough that we'll trust you to pay this back for the next 30 years? Lenders want to see 2 years of employment history, not necessarily at the same job, but in the same field. So if you switch from one accounting firm to another, you're probably fine. If you went from accountant to personal trainer 6 months ago, that's going to raise some questions. There's also a rule about probationary periods. If you just started a new job, some lenders want you to be past your probationary period, typically 90 days, before they'll count that as income. What about bonuses, overtime, commissions? Lenders can count these, but they typically want to see a 2-year history of receiving them, and they'll average it out. So if you're counting on a recent raise or a new commission structure to qualify, you might need to wait. Here's something most people don't know. Going from W-2 employee to self-employed resets your income clock. Even if you are making great money as an employee, once you file self-employment taxes, lenders will want to see a 2-year history of that self-employment before they'll use it. So if you're planning to go out on your own and buy a house in the same year, make sure you have a conversation with a lender first. All right, let's talk about money in the bank. Lenders want to see that you have enough assets to cover your down payment, your closing costs, and ideally a few months of mortgage payments in reserve after you close. Because they want to know that if something goes wrong, you lose a client, your car breaks down, something else happens, you'll still be able to make your mortgage payment. Down payment requirements vary by loan type. Conventional loans, typically 3 to 20% down. FHA loans can go as low as 3.5% down as long as your credit score is at least 580 or above. VA loans for eligible veterans can be as little as 0 down. And USDA loans for eligible rural areas can also be as little as 0 down. Here's the catch that surprises people. Lenders care about where that down payment money comes from. This is called sourcing and seasoning. If your savings account has been building up over time, great. That's seasoned money. They can see the paper trail. If you suddenly have a $10,000 deposit and you can't explain where it came from, that's a problem. If a family member is gifting you money for the down payment, that's fine, but there's required paperwork. They have to write a gift letter stating that it's not a loan, because if it is a loan, it's debt, and that new debt affects your debt to income ratio. Large cash deposits right before you apply are a red flag. Lenders will ask you to explain and document every large deposit in your bank statements, usually anything that's over 1 month's income. So if you're about to apply, now is not the time to start depositing random cash. So let's recap. To qualify for a mortgage, lenders are looking at 5 things: your credit score, your debt to income ratio, your employment history, your income, and your assets. The good news, every single one of these is something you can work on. None of this is permanent. I've watched people go from completely unqualified to getting the keys to their first home in under 12 to 18 months because they understood this stuff and worked this system. That's what this channel is about. There's no hype, there's no upsell, just what you should have learned in high school. If this was helpful, subscribe and hit the bell. Every day I put out a video that breaks down something in the banking and money world that nobody necessarily explains clearly. And drop a comment. Tell me where you are right now. Are you just starting to think about buying? Are you already in the process? Or did you get declined and you're figuring out why? I read every comment. I'll give you practical advice. And those comments help me make videos that are going to help all of you in the future. Thanks for tuning in. I'll see you tomorrow.